Welcome to this lunchtime panel. If you are in BST time zone, hopefully we'll entertain you while you snack on whatever it is that you're currently feeding yourself. And while you're eating your sandwich or taking in your soup, you might be thinking about the climate impact, or even maybe the biodiversity and water impact of the food that you're eating. But are you also thinking about whether there's any modern slavery in the supply chain that brought that food to your plate today? Are you thinking about whether the farmers got paid fairly for the food that makes up the ingredients within your lunch? And that is the S in the ESG. And over the next hour, I, along with 4 people that know a good deal about this topic, are going to knock some of the ideas around the S and ESG and hopefully bring some of it to life for you. So I'm going to dive straight in and engage our speakers. Andrew Cave is the head of governance and sustainability for Baillie Gifford, and actually, I must admit, used to be my boss, so I have to be very polite. Andrew, we'll come to you first. You wrote a book for your clients about corporate responsibility and sustainability, and you actually suggest in that CSR, modern sustainability, actually started from the S, from human rights. Do you want to just describe that in a little bit more detail and how we've got to where we are today, where the E seems to be dominant?
Yeah, thanks, Tom, and delighted to be here speaking at GEFI today. So yeah, the project to do a sort of short history of ESG started with our clients repeatedly asking me several years ago about, where does ESG come from? Because it sort of skyrocketed to importance sort of post 2015 and became a sort of mainstay of investment for asset owners and asset managers. So thereafter, but as some of us who've been in the kind of field a bit longer know that there's a much longer heritage to ESG. And when I started looking back into it, what you find is the kind of early funds and the kind of early work was almost always on S issues. So S was the original issue, and a lot of the kind of early interest in responsible investment came out of human rights issues. So you had the Universal Declaration of Human Rights produced just after the Second World War, and that provided the kind of foundational framework to look at different kinds of issues around the world and gave a sort of literally universal baseline in terms of expectations. The S issues really come to the fore though with the Vietnam War, when you start to get protest movements in the US, and you get a number of investors interested in setting up funds which actively divested from some of the corporations which were involved in kind of Vietnam War effort. So corporations like Dow Chemicals, who were involved in manufacturing Agent Orange, that was used as part of some tactical warfare. So you get the first kind of responsible investment funds coming to the market, where you can put your money in, safe in the knowledge of putting money into those kind of corporations. And that kickstarts the modern responsible investment industry as we now know it. So not long after that, you get the first stewardship funds appearing in the market, and sort of various screened ethical products. And what I would say is that it remains a very niche market for a long time. So it's right up until the last of really 10 years that's a small corner of the investment sort of market in terms of assets under management. But then when you get to really 2015 is the inflection point with the Paris Agreement, and then the UN Sustainable Development Goals coming online as the successor to the Millennium Development Goals, you get this huge tailwind of kind of interest in responsible investment. And the S in ESG is still there, but by this point, it's been somewhat crowded out by E, which has clearly become a sort of pressing global crisis. So quite understandably, environmental issues and climate change in particular come to the fore, and have become probably the most commonly cited issue we talk about with our clients. But that is changing again. I think the pandemic has reframed how people think about social issues, and it's shone a spotlight on some of the inequalities in the economy and across economies. Just look at the debate right now about the distribution of vaccines globally. So S issues have really sort of come back to the fore with the refocus on public health priorities and just actually the importance of international cooperation to address issues. One thing the pandemic showed us was you can't fight these things on your own. No country is an island. So I think there's a renewed interest in S issues. And if you look at the agenda for the G7 meeting coming up in Cornwall, tax and some tax harmonizations on the agenda, and cooperation and a whole range of different social issues. So I think really exciting times, and certainly in our line of work in asset management, we're beginning to get straight in terms of what we need to do with our clients in E. But I think S is very much up in the air, because as we'll get onto today, S is hugely complex and culturally relative. So I think I'll probably stop there as a way of intro.
That's really great, Andrew. Thanks very much. It's a brilliant whistle stop tour. And several of the things you mentioned there, right the way back to the Universal Declaration of Human Rights, the Paris Agreement, the UN SDGs, those are obviously big global frameworks. And then one of the things you mentioned towards the end there was that's what's the kind of regional element to that. And turning to Leslie Ann, who you've worked across continents, I mean, what's your experience in terms of how the balance between E and S and perhaps G differs in the different places that you've worked?
So my journey started with S for sure. I was part of the original M-Pesa team back in 2005, and we used some corporate social responsibility budget from Vodafone to kickstart the whole of what we know today as the kind of inclusive payments industry. And certainly S is a big part of the conversation. However, when you're in Africa, the reality is that climate change is a big conversation, and there's a need for resilience to crop failure. And the conversation is potentially more about the business impact and the social impact of some of the climate change that's happening, more than some of the conversations we have in the UK around environmental factors. But it's an incredibly important conversation. And I mostly work in the financial inclusion space, and so a lot of what we'll talk about today when I talk is about kind of what's going on with financial inclusion. But there is innovation in insurtech around agri. There is all kinds of private sector innovations. And what was amazing in the panels that I listened to earlier this week from both Asia and from Africa is actually there's some common foundations that both are talking about. So some of the things that I heard that I completely resonate with: cash is king. The amount of cash in the economy is huge, and that changes the game in terms of what you can do with things like data and how you can serve the informal sector. Bricks and mortar are not enough. We are, even in the UK, thinking about the role of branches post-COVID, but we've been thinking about that in an African and Asian context since 2007, when actually the true innovation of M-Pesa was the fact that people could go to their local corner shops to do some basic banking. And it gave people back their time, and time is the economy. If you have to close your shop in order to go and do some basic services, such as work with your microfinance institute and go to your group meetings and all these things, it means you're not earning money. A big topic across all of the conversations was women's financial inclusion and how entrepreneurial women are. When we talk about SMEs, a lot of them are actually businesses being run by women, and that there are inequalities across that kind of space. And access to finance when you are a small trader and a woman, it's not simple. And the role of the informal financial sector is immense in that. My personal mission these days is with an organization called Modular Foundation. That's where we take the G and we look at the fact that we need public-private collaborations, and we need to look at what is the role of digital public goods in getting innovation plus regulation and consumer protection all together. And actually the role of payments rails, real-time push payments rails in the COVID crisis has been an immense conversation in the industry. How do you get those disbursements to the people who need it most when they're not banked? It's part of your resilience response, and there's a way to do it by thinking about how do we act better together. One of the really interesting conversations for me that I heard this week is about the concept of blended finance and how public finance is really important, but often in an African context, this came out from the team that talked on Monday, it's not enough. And actually, we need to think about innovative ways to unlock private sector finance and to work in a blended way. And so they talked about a fantastic initiative that is helping across 9 countries think about water resources, crop resistant to climate change. And I think there's more of that to come in the future, a way for us to do some blended public-private collaborations in this space. But it really did strike me how much there is a common theme when it comes to financial inclusion and customer and serving customers well, and how that by thinking about social issues, you are actually thinking about governance issues and about environmental issues as you go.
Yeah, very, very good point. And with all these things being so interconnected and intertwined with one another, I think it possibly sometimes very difficult to then draw them out and treat each one separately. So Elena, coming over to you and your role for the PRI, how does the PRI deal with that kind of interconnectedness of all the different information, and how the for a global framework, how does that work if you're looking at organizations on different continents, for example?
Yeah, it's definitely a challenge, but not something that makes it impossible to work on the S of ESG. I think, well, in our case, well, and as Andrew mentioned, I mean, the Universal Declaration of Human Rights obviously is a huge step for thinking of the S, and that's the approach that we're taking at the PRI. So we're using the UN Guiding Principles for Business and Human Rights as our global framework to look at S, at social issues. And this is because, well, I mean, it is an international recognized standard. It's been unanimously ratified by many countries around the world, including those where social issues are quite important and quite, just very relevant as well. And in that sense, I mean, it's a good framework because it makes investors to think about, well, what is their policy around human rights? And then obviously goes through a process of due diligence, which means understanding what are those human rights that are more severe in their operations and in their portfolios. And that's where the regional or localized angle comes from. So it's for them to understand then how their approach needs to change depending on the severity of these issues and depending on the sector, depending on the geography as well. So it is very much regionally dependent, but there is a way to look at this in a universal way. And the universal approach is that we need to ensure respect for human rights. Independent of the duty of states to protect human rights, investors do have a responsibility to respect human rights. So that's the way to see it universally, but obviously that will have implications locally. And in terms, I mean, I think comparing it to environment, we like to put things in boxes, but obviously there is a lot of linkages between them. I mean, even for the Paris Agreement, you have the concept as well of just transition that is included in there, which is a social aspect of climate change. And it's like, as we talk about stranded assets, just transition talks about stranded communities, and it's how, as we move to a low carbon economy, then what do we do with those employees and workers that are going to be left behind because their industry is going to become obsolete if we try to go to a low carbon economy. So there is a lot of transition implications that we need to think about that will have a social component. And the same when we think about climate change, it's about livelihoods of people, and it's about climate migrants, for example, is something that will be an issue for companies and investors to think about. So I think everything comes together, and even though the classification helps in thinking through the issues, it is important that we think about the linkages as well, and just to know that they don't work in silos. I mean, social activities will have implications in the environment and vice versa. Or thinking about renewable energy, which obviously many investors are very interested in because it has a very positive component when it comes to the environmental side of things, like actually allegations of human rights violations in the renewable sector have been increasing over the years and have becoming worse. So it's something for investors to think about when they put money behind renewable energies, to also consider the social implications of that. And in terms, I mean, it is a complex topic, and we said like measurement is difficult, but again, that doesn't make it impossible. And this is what due diligence help with. I mean, after you go through the process of due diligence, then you can think about, well, where is the gap and why is this gap there? And then what should be our strategy and the objectives and targets? And from there, think of indicators that you need. And yes, there is a myriad of indicators, but you can always think about what are the most important ones and try to follow on those. But obviously, I mean, I think, yes, standardization is an issue, but the more investors ask for this information and the more companies report on it, the quality of this information will be better. So waiting for that standardization and waiting for that perfect information, I think it would be a mistake. And also because we say that environment is easier, but not necessarily. I don't think we have a standard way of measuring climate change or standard way of measuring environmental impacts. And even within environment, you have a lot of linkages in terms of strain on natural resources. So for example, when you produce cotton in a region where water is an issue, and then that cotton is exported to Europe, so then who, I mean, you are also, even though the water is not from Europe, you are also exporting basically that risk and that water scarcity to that continent as well. So obviously there are a lot of interlinkages, and I don't think it's that straightforward as people would like to see. So, and I don't think it's something to say that we need to wait for perfect to start measuring social issues. It is something that investors can do right away. And I would suggest, the UN guided principles as a way to do it.
That's really helpful, and you've touched on a lot of topics that we'll probably come back to. Fabulous. That will run through of lots of different things in there. And I think this idea of trying to keep our buttons in the boxes, and in reality, you need to access all the buttons. It was something that came up very clearly in Professor Dasgupta's talk yesterday. This point about things like water, which are a global public good, and whether they're in the common areas like the high oceans or in political states, and how we adjust the economics to take those things into account are ultimately social factors. But Leslie Svengadar, who you are a VP at MSCI Research, I saw you nodding when Elena was talking about measurement, and obviously that is very much your bag. And again yesterday, Andrew Mitchell from Global Canopy pointed out that climate has a rather easy time of it in that they have a ready-made currency in terms of tons of carbon, but that's absent from lots of other areas. And I think the social areas is a very good example where there isn't a clear single metric that people can collect around. How at MSCI are you going about measuring the S in ESG so that it's easier to make direct comparisons between companies, regions, sectors?
Sure. Thanks very much, Tom. Yeah, I think you're absolutely right. This is a significant challenge for the S, and I would even add that this is also a prejudice against the S, and that's why I was noting when Elena was talking. I think typically the S pillar is seen as more subjective, soft, and less consensual than its environmental and governance counterpart. And I think this image is actually only partially true, because you can quantify the S even if it's difficult. So what we do at MSCI when we evaluate a company's capacity to mitigate social risk, we of course rely on the company's public disclosure, but not only, because as you mentioned, this would differ widely from one region to another. So to overcome that gap, that bias, we leverage as much as possible what we call alternative data sets. Those are third-party sources that can complement the corporate narrative. For example, when you evaluate a food producer or a pharma company on product safety and quality, we actually leverage food and drug regulatory databases, which are much more comprehensive and exhaustive than corporate disclosure when you want to look at product recall and the severity and the frequency of those product recall. Similarly, when we look at health and safety performance and the actual level of injury and fatality that can happen within a company's operation, we find really useful to leverage National Health and Safety Agency database in certain markets where corporates tend to be really timid when it comes to that type of disclosure. And another example that I'd like to mention on that front, on the mitigation practices, is around the food producers again. This is actually the sector that I cover, so you'll see why I keep on referring to that industry. And really, if you know well that industry, you would know that all those companies would say that they are transitioning towards a healthier food, and they will claim that they've reformulated their products with less sugar, less fat, less sodium. But actually, if you take a closer look at their product portfolio and you measure their products' health against independence and scientific nutritional criteria, you would see that this is not completely true. And what we do at MSCI is really not only relying on the company statement, but actually evaluating ourselves the healthiness of the company's food product portfolio. So we really screen the company's products against nutritional criteria from recognized health organizations, and we look at the type of products and whether it can be considered as a basic product. And by basic products, I mean, you know, a product that can contribute to the daily intake of essential nutrients, and whether it has acceptable sodium, fat, and sugar level. And based on that independent assessment, we identified that only 34% of the revenues of the food products constituent of the MSCI ACRI index were aligned with such independent nutritional criteria. So that gives you, you know, a different level of picture from the corporate disclosure. So that's what we do to complement the corporate narrative when we look at the mitigation practice. And how the company reduced the social risk. But another very important things that we do within our ESG ratings, and that is not specific to the social pillar, is that we don't satisfy ourselves in just evaluating the company's policies and programs. Every time we look at a social or an environmental risk, we want to see what's the specific exposure of the company to these risks, based on its unique business footprint, taking into account the company's revenues and assets breakdowns per geography, but also based on operating segment or how large the company's workforce is. And when we cross-reference this company's data with our own proprietary database, where we have more than 1,000 business activities and hundreds of geographies that we have mapped with specific sectorial, regional social data based on third-party sources, academic literature, and regulatory database, that really gives us a much more granular information on how vulnerable the company is, because we know that the level of labor unrest will be very different from one region to another. The level of labor violation will also differ a lot depending on which business operation you're focusing on. And maybe just to give you another example for measuring the exposure of a company to a social risk, if you take privacy and data security issues, we would be able to identify, even if the company does not disclose any information on that risk, you know, how exposed the company is to regulatory risk if it operates in countries with stringent or strengthening privacy and data security regulation, but also based on the percentage of revenues that comes from business activities that typically rely on handling a lot of personal data on consumers, as well as being exposed to a high level of cost of data breach using third-party data. So all in all, we have almost 45% of our ESG rating signal that comes from those alternative data sets, and social is definitely not an exception to that.
That's fascinating, because one of the things that is regularly kind of leveled at social issues is that they are more qualitative, as I said. And to hear that very scientific approach where you're looking at sort of independent nutritional data and comparing the stats around sugar and fat and things like that is fascinating. Elena, just coming back to you, I know you were recently part of a working group trying to do some myth busting around the S in ESG, and that was one of the points that you made. This combination of qualitative and quantitative is hugely important in social. Is that something that you really are seeing significant development in the ability of analysts to look at both of those sides of things?
Yes, definitely. I think we've seen an increase of interest in qualitative data and understanding, and I think investors as well, as they gather data, I mean, they don't just take one source of data as the whole truth, but do try to gather more information from different sources, and especially for social issues and where the impacts occur as well. It is important for investors to gather data from situations on the ground. So we also see investors looking at information that is not necessarily just coming from the companies. And as Leslie was mentioning, I mean, it's a similar approach, and it's also looking at local NGOs, local human rights groups as well, just to understand then, yeah, what is the other story coming from the ground, or even you have a lot of sites and even data providers that are looking at information such as allegations against the company that come through the media or different regulatory bodies as well. So definitely there is an appetite to look at more than just quantitative data. And also because if you think about situations on whistleblowing programs, for example, if you have an increase on allegations, it's not necessarily a bad thing, even though it sounds bad, but it might be, I mean, you need to dig deeper to understand whether it's because the situation is getting bad or is it because actually the system is getting better. And therefore people feel more empowered to come forward with their own issues and problems. So actually, like, having more allegations might be a positive thing and might be a change in attitude and culture within a company. So that's why it's important to balance the qualitative and quantitative. And I think, yeah, finance is very used to quantitative, but definitely, I mean, we do see a shift in that perception, and we do see a shift in the use of more qualitative data when looking at social issues.
I really like that point about when something looks worse, but actually that means it's better. And I think one of the examples that is quoted regularly in that space is around modern slavery, and historically it's not been very well identified or picked up, and so there was lots of reports with zero in them, and Tony's and others, Tony's Chocolonely and others have taken the approach that, well, it's there somewhere, so we just need to work harder to find it, and that's kind of really changing the approach. Andrew, as an asset manager yourselves, and looking at that kind of sort of qualitative, quantitative, I'm just interested in stepping back to the point that was made earlier about the link between all of the different issues. And I read recently somebody was saying that the renewables revolution will be built on mining, and mining is obviously an industry which is fraught with social issues. Is that something that Baillie, I know Baillie Gifford have got really some very forward-thinking investments around the renewables revolution, so that must be something that you've got your eye on.
Yeah, absolutely, Tom. And your question is spot on and shows the linkages across these pillars. You know, to ESG as a sort of shorthand acronym that sort of helps people sort of divide up reports, but in practice, there's almost total overlap across all three, of course, and that's a good example where we have some tough sort of choices and conundrums ahead of us as we think about this sort of low carbon transition. And that most of the technology we will need for the transition is already there or emerging, but it's the ability to do it in a way which is just and fair and respects to human rights and other kind of issues, which is probably the biggest challenge. So if you just take energy transition, doing that in a way which is not detrimental to the lowest socioeconomic groups who pay the most for their energy is absolutely key. So this is one example of an S issue being embedded with an E. But the point you mentioned is fundamental. So a lot of the technologies we're going to need a lot more of over the next 20 to 30 years will depend upon mining. And at the moment, the mining sector is something of a pariah for responsible and ethical funds. Very few hold miners and are willing to hold mining companies. And I think that is problematic, because we need products like copper, coltan, cobalt as some of the key sort of building blocks for the sort of battery and electrification revolution, for electric vehicles, for the kind of technologies that will enable us to be much more resource efficient across entire industrial processes, Internet of Things, smart homes. All of that will be driven by those kind of mined materials. So one of my kind of issues with kind of the way the responsible investment world is developing is I think it's in danger of sort of setting too high a bar and a sort of pure view of what a responsible investment is, whilst somewhat ignoring the reality of the economy. That Apple depends on coltan and cobalt, and Tesla depends on cobalt. So we need to kind of, I think, reinvigorate that whole debate around what is sort of ethical, responsible mining like. And we frankly need to help the big players. We need to get in behind some of the big mining conglomerates and, as long-term stewards of capital, support them to improve their approach to S issues. Because artisanal mining, as it's called, it's a euphemism for sort of small-scale mining, shows how bad it can be when big corporations step away from sort of key products. So you just have to look at what's happening in Congo right now, where a lot of the big mining companies with better reputations have stepped away from the cobalt mining sector and left the space to other international operators and artisanal mining. And there are enormous social issues in the Congolese cobalt sector. It's one of the most difficult areas of, I would say, of the contemporary value chain for electric vehicles and technology products. So we recently brought a speaker in who's been out in DRC for 10 years with a lot of expertise in artisanal mining to try and educate our investment staff about what we can do about these issues. And there are certainly things that can be done. That there are standards emerging for what you might call fair trade cobalt, and I think we need to get in behind those and make them work, because there's no ready alternative. Congo provides a huge amount of the supply of cobalt just now, and there's no other economy which can scale it up in a way which will help us with the low carbon transition.
Yeah, no, absolutely. Leslie-Anne, in your opening comments, you actually referred to this need for standards, not just to be set by companies and ratings agencies and investors, but also that there's a need for public and government, public regulators and governments to kind of get involved in. And obviously your example was more around financial inclusion than around mining. But how much do you feel that balance between private innovation and public regulation is important in the S factors?
It's really interesting that you brought up artisanal mining, because actually we had a speaker at our conference about 6 months back from the innovation space around artisanal mining, bringing up exactly the same issues around the provenance and the fair trade, and how do we help people retain their income. It's all very interlinked, but there are people out there who are definitely innovating with interesting products around provenance and the like. It's a complex supply chain. Fundamentally, a lot of this comes down to inclusive identity and inclusive payments rails. As a fundamental way to get more quantitative data, they kind of fundamentally need to be in place, and they have to be accessible to all of the population, and that's not a simple thing to achieve. And as a consequence, a lot of the data on the informal economy is very qualitative, and a lot of the evidence is it's not driven by the kind of numbers that we would see in the Western space.
Yeah, no, absolutely. Leslie, one of the other things that Elena referred to was the balance of voluntary and mandatory information available, and that is different for different organizations at the moment. What's your view in terms of the balance of voluntary versus mandatory? Do you think that we're going to see more and more? I mean, EU human rights legislation is certainly heading in that direction, but on the S more broadly, do you think that's a trend we will continue to see of more mandatory?
I think on the social front, we are seeing indeed an increase in terms of regulations. The first that come to my mind, of course, on the human rights front, and especially for the modern slavery legislation in several developed countries. We recently published a paper on that, on what it would mean for several companies of our universe. I think also if we look at other social topics that are not always on the top of people's mind, but privacy and data security, went through a really important regulatory momentum in the EU more than 2 years ago, and we're really seeing like the snowball effect of this EU regulation across other countries. So the privacy regulations and putting back the individual's right at the center of the privacy legislation is something that we're really seeing spreading across different regions, including in Asia, where we're seeing also corporate disclosing more in terms of their privacy policies and how they provide further rights and further transparency to individuals on what type of data they collect on them, and what are their rights to ask certain data to be withdrawn, and also to have some data being changed or amended. I would say, even if you look at opportunities health and nutrition, we've seen that there has been a huge increase in terms of sugar taxes, and I think COVID is likely to further accelerate that momentum, because we've seen that overweight and obese people had higher likelihood of going through more severe form of COVID. So the whole obesity issues is more and more tackled by a lot of states and countries who are asking for cleaner labels from companies, and also just levying taxes against company, mainly the beverage company. So I would say it's very much growing, but we need to be anticipating those regulations or those mandatory disclosure, because they're still very disparate from one region to another. And it's important that we are already able to collect some of those information across our whole universe for our investors, so they can be able to identify which players are the best or worst positions towards this, more mega trends that we're seeing, where there is more regulation.
Yeah. And at what point is there just too much data to be useful as well? I think that's one of the things that I'm always sort of fascinated by. I mean, Andrew, your team, the analysts in your team, and in fact, Leslie, in your world, it just gets to the point where there is so much disclosure and so much information. How do you decide what's the useful information? And just picking up on a question we've had in from Tendai Stefano, the distinction between transparency and exposure. So some companies actually shying away from even getting into certain areas and trying stuff because they're fearful about exposure, because of all this kind of drive around more and more transparency, and they're just a bit, maybe even just a bit immature around something rather than bad. How do you balance that stuff off, Andrew?
Yeah, I mean, there's been an explosion of data, but I think there's a big difference between data and insight, and lots of data doesn't actually help you get a better insight into companies' practices and impacts. And so there's been a sort of huge increase in the amount of material put up by companies, and that is still often quite unstructured and sort of using sort of company-specific metrics and so on. So it's got hard for investors to compare that. Now the kind of good work being done by SASB and GRI and others on the standardization of standards is all greatly welcome, because that allows us as investors to do more comparable analyses across sort of companies and sectors. But I think you've heard me say this before, Tom, but when you actually think about data, we're just at the beginning of this. The kind of this whole ESG industry is actually completely nascent, and we know almost nothing actually about companies and supply chains and impacts. It's remarkable how little we know. And why do I say that? Well, it's because the kind of the information just isn't there. Global capitalism didn't evolve in a way where there was clear social and environmental certification of different value chains. So to give a really simple example, You take something like feedstock, Western European feedstock that's fed to sort of chickens and sort of sheep and cattle. Should be a very basic product, and you think relatively easy to carbon footprint to sort of work out the environmental impact. Not a bit of it. It's actually made up of lots and lots of different products. A lot of it is imported soya, which comes from Latin America, and a lot of that Latin American soya is coming from the clearance of sort of virgin rainforest sites. So there's potentially an enormous carbon footprint to the feedstock you give to your free-range chickens. And this is me speaking from experience here. I think we've got an enormous job to do as a community to get over the data and to get better quality of data. And I use the analogy of the first Enlightenment maps, which had almost nothing filled in. The map makers only filled in the bits they knew for certain, which was about sort of 10% of the globe. That's where we are in ESG data. So yes, it's great that there's a huge industry burgeoning in terms of providing ESG data, but we need to structure it, we need to improve the quality, and we need to get over how to organize it better. So frankly, analysts can sort of see the wood for the biomass, so to speak.
Absolutely. Leslie Ann, here we are all talking about these kind of grand issues in a very kind of sort of global and joined up and macro sense, but you've really got a lot of experience of dealing with this stuff on the ground, and certainly when we've spoken before, the examples that you give really bring it to life. One of the things that Leslie brought up just before was around privacy and fraud and data becoming almost another mega trend around S. And I just wondered whether you could describe some of your experiences around working with financial inclusion and financial capability, and how that then runs into some of these other issues.
Sure. Let me see if I can find an example that helps with that. So I would say first and foremost, mobile money providers, banks, telcos, everyone very much has data privacy at the center of their world. Open banking is not a huge conversation yet, and the risks involved in open data are a whole different beast of conversation again. But we created a really innovative product back in 2012 where we linked information from the telco sector to a bank with consent with the customer. So we were able to help a bank understand that this customer has propensity to pay. They are regularly buying airtime. They have had an M-Pesa account for over 6 months. We know their KYC because they did a formal registration process with us. They're a good customer. And as part of that, they were able to open a bank account and save digitally, completely digitally, using the KYC information that we held at M-Pesa, and to as a consequence, be eligible for small loans. Those loans were used for the purpose of access to finance. So you'd find that small traders would take a loan out at 4 a.m. in the morning. They would use it to buy stock for their shop, and they would then go trade all day and repay the loan by 6 p.m. that evening, and do it again the next day and again the next day. That is financial inclusion. It's not having an account, it's giving people the ability to say, do you know what, I am worthy of liquidity, and you should help me and I will repay, and look, here's repeatable. And you bring people out of poverty when you do things like this. However, it's got the ability to be cloned and copycatted, and it's got the ability to be almost taken too far sometimes, and then therefore there's a need for governance and regulation and thoughts. So what's happened after that is an awful lot of copycat products. When you've got smartphones in the mix, you then go to the next level. What is open banking in an emerging markets context when there's no data at the banks because customers are unbanked? Actually, it's their call history. It's what's in their SMS messages. It's what they're using their phone for. It's their battery usage. It's how they're charging their phone. It's a whole ream of data. And what we have seen is quite a lot of fintechs going, how do we actually harness the value of what we do know about these customers? And they're doing it in a way where they want to create an ability to know the customer better. However, what it can do when the industry is not regulated, or there's a central kind of way to understand how over-indebted people are, there's an ability to innovate too far and end up with a customer borrowing from this low-cost service to pay off this low-cost service, and it creates a consumer protection issue and an education issue. So I think there is a need for private sector innovation and regulators to work together and to make sure that consumer protection is at the core of what we're doing, and that we're not making people over indebted through the use of too many of these services. And even to the extent that I've seen an awful lot of innovation on top of salary schemes, where money is debited before they actually receive their salary. But it's really important that that is not taken too far, and they don't leave with enough money to actually buy their food and buy the basics of life. And that's like one of the examples that we talked about, Tom, when we were catching up at this beforehand. There's a lot of power in data, and there's a power in using it responsibly with consent. But there's also a need for shared services and consumer protection, and doing that efficiently in a way that everyone is not doing their own siloed ecosystem, that actually we're thinking about this together. Back in the world of mobile money, we were seeing the kind of fraud scenarios that we see in the UK today around SIM swap fraud and push payment fraud. We were seeing this with smaller value transactions back in 2007, and we've been solving these problems through various controls over the years. The amount of money is different. We're not seeing people lose 10,000 when their solicitor's account is hacked and the bank account details are changed and a phishing email comes in. What we're seeing is a very similar attack with a different amount of money, but it's still people's livelihood and it's their whole savings, even if it's £200. And so we've been thinking about these consumer protection issues within the financial services inclusion space for a long, long time.
Yeah. As I expected, a very rich example that really brings out a lot of those different issues. And I think one of the things that's really interesting in your example, Leslie-Anne, is all these different operators working in a similar space, but almost with
intentions.
With different intent, with different kind of, and also different feelings about what good enough looks like. So that'll do for that organization, but then another organization will say, oh no, that won't do, it needs to be this much better. So I mean, Elena, coming over to you, I saw you on another panel on Monday with PRI. Were involved in another S initiative with KPMG, and one of the things in there is about so how do you decide what good looks like in the social space? Because for climate, it's now widely agreed that under 1.5 degree raise and net zero is what good looks like. How do you decide for these issues what good looks like?
Great question, and I mean I might not have a definitive answer on that one. I think again, I mean, the comparison to climate, I don't think there will be one indicator that would tell us if you do this, then you solve social issues. And I think that's something that we're going to have to live with, and the fact that social issues are more complex, and therefore it would be a combination of indicators that you need to look into. I think, again, going back to respect for human rights should be, I mean, I think the way of thinking about it is maybe in terms of minimum safeguards. So what is the minimum that is acceptable, and then go from there. So respect for human rights is something that we need to always think about and consider, well, in all of our activities, how much are we impacting people and how much are we infringing on their rights, and then consider that as the minimum baseline for the activities that you do. And the same, I mean, in that panel, we were discussing whether modern slavery could be that one indicator that could take the lead in terms of social issues. And my comment was like, I mean, it is a great first step because it's one of the worst violations of human rights that it exists. However, not being on modern slavery doesn't mean that you are in a distant job. I mean, there are many other conditions that that are not necessarily there, even for people that are not on modern slavery. So we need to think as well about freedom of association, living wages, social protections as well, that are not part of the modern slavery conversation, but are part of the respect human rights. Because if we think about human rights as the Universal Bill of Human Rights, but also the ILO conventions, then that's a good benchmark on understanding what good looks like. But I think that the trying to think about getting one standard, I don't think is the correct way to see it. I mean, I think we were going to need a combination of metrics when we look at social issues. But definitely, I mean, we cannot think about better working conditions when modern slavery is still rampant and is still permissive in every geography in the world, for example. So yeah, there are some minimum safeguards that we need to ensure.
So perhaps the idea of a lead issue rather than a coordinating issue maybe is a simpler way to think about it from a social pillar. It's interesting, we've managed to get, I think, 45 minutes, 50 minutes into a conversation about the S pillar, and none of us have yet mentioned diversity, equity, or inclusion, which is pretty surprising. It's down here as one of the kind of mega trends that have obviously really matured over the last year or so with the Black Lives Matter movement that erupted after the murder of George Floyd. But also in the UK, there's been a second wave of the Me Too global movement around gender equality as well. I wonder if any of the panelists would just like to comment on the relative maturity, perhaps, of diversity and inclusion as a social issue versus some of the newer issues that are just emerging around whether it's measurement or targets or any of that. Any hands, or I'm going to have to pick someone? Leslie Ann.
So I'm going to object and say I absolutely have talked about gender issues and inclusion issues.
You did,
maybe
in
in
your
a different
context. You did in your opening comments. I take it back. I apologise.
But I think they're in a different context in an emerging markets world. So I was talking about women from the perspective of social entrepreneurship and access to finance, and the perceptions of whether women can run a business already and whether they have the right paperwork. And in the Pakistan presentations, that was talked about deeply, actually, as if you want to bring women to the financial inclusion sector, there has to be women in the shops, in the branches, in the ecosystem that they interact with. Fundamentally, it's really important. It has come through strongly in the emerging markets context, but it's kind of got a different flavor to it than possibly the way we think about it in the US and the UK. It's got a different kind of impetus behind it. But yes, inclusion and gender equality is a huge topic in the financial inclusion kind of development sector space.
Yeah, and how do we avoid just taking a very Western liberal view, not just of gender equality maybe, but human rights and some of these other things? One of the comments that I saw at the panel that Elena was on Monday was, how do you know what's right for the whole world when you're sitting in Edinburgh or Frankfurt or Paris? Andrew, have you got any views on that?
It's a really important issue. It's very issue specific. If you look at something like data privacy, the kind of attitudes are entirely different between the US, Europe, and China, for example. So it really does matter what market you're talking about and what sort of expectations and norms are. I think for the kind of core sort of fundamental human rights, we shouldn't entertain the idea that they're relative. I think that's the entire point of the Universal Declaration. There are some inalienable rights that should be enjoyed by all people in all countries, and I think we need to resist hard the idea that there's a sort of cultural nuance to sort of basic human rights. So I think the Universal Declaration is still as relevant today as when it was published, for that very reason. But I do think beyond that, when you go up the kind of Maslow's hierarchy of needs sort of pyramid to different kinds of issues, yes, it becomes more relative. If there's time, I was going to finish on a few sort of emerging issues, but you might have a few more questions before that.
Before we come to emerging issues, I was just going to ask Leslie a little bit more about the kind of current megatrends rather than the emerging issues, because I think, as I said, COVID and and diversity and inclusion have certainly felt like significant megatrends, and with the G7 agreement on tax last week, I think tax is another one. Are there other, for MSCI, are there other megatrends that you feel are particularly hot topics at the moment?
Yeah, I mean, I can not mention, racism and diversity that you discussed earlier. That was obviously a tremendous and still a tremendous topic among our clients this year, and notably among our US clients. And as a result, we are newly collecting corporate racial diversity data for the US market to address this demand. But this is a type of data that is not consistently disclosed, and for certain markets, for example in France, it actually poses a legal issue to disclose about the racial data of your workforce. But it is definitely something that we're looking at, and where we're seeing a huge demand among our institutional investors. I think this issue is also part of a bigger mega trend that we identify in our trends paper at the end of last year, which are social inequalities. And COVID-19 that you were referring to has really put its thumb on the top 1% side of the wealth scale, and really undoing decades of progress towards a greater equality. And what we're seeing at the moment with the proxy season is that investors are closely monitoring how fair the executive remuneration will be for 2020, bearing in mind that employees have had to take a heavy toll during the crisis with furlough, restructuring, and also more health and safety risks when they had to be on the front line. So it's interesting to see how the financial burden of the crisis is redistributed between the different stakeholders of the company.
Yeah.
And I think, within that big social inequality topic, what we've seen is that investors have relied on the SDGs, the Sustainable Development Goal, as a framework for developing their approach to address inequalities, because a lot of the SDGs are referring to inequalities. There is SDG 10, of course, but also some others, linked to poverty, hunger, or health, or education, gender equality, or decent work. And we're seeing that investors are using that framework to see the net alignment towards those targets to approach this social inequality issue, which is extremely diverse and complex. So it's a way to rely on a recognized and consensual framework.
Thank you. We've got about 2 minutes left, so I'm going to come to each of the panelists, and I'm going to ask you. Leslie's just very kindly filled in a couple of the gaps of the hot topics that we hadn't talked about. But in terms of the hot topics, when we sit down in next year or the year after, what are the things that are emerging for you that you think are kind of the emerging social issues? Elena, I'll come to you first, please.
Sure. I think, at least from the work that we're doing at the PRI, diversity, equity, and inclusion is a big one. But I think it's thinking of those three terms. I think we think of diversity too much on the number and not so much on inclusion and equity. So it's understanding barriers and advantages that people have depending on what group of society you come from. So that's important. And working on inclusion and not so much on how we see the numbers pan out. And decent work. I mean, as the COVID-19 put a huge spotlight on working conditions, on social safety nets, and the cost for governments for not having those social safety nets in place. So I think, improving working conditions in different countries and improving working conditions in supply chains is going to be a big trend, especially when we see the low carbon economy transition, the transition to the technological transition as well, and demographics. I mean, when we see an aging population in developed nations, but younger populations in emerging markets as well. So I think those are the issues that we're going to be focusing on.
Great. Leslie Ann, what's your view?
In my world, there's
Yeah.
a mega trend around digital public goods and the need for infrastructure, fundamental infrastructure as the rails for improvement. So I obviously focus on payments. There's a lot of focus around digital public good and inclusive identity as well. And there's that need for public-private collaboration to get the job done is a big part of the conversation.
Definitely, and I think that connects very closely with the work around the just transition. You talked earlier on about agriculture as a significant income, and the just transition is a huge part of that, isn't it? Leslie, how about you? What's your kind of main emerging issue that you would like to talk about when we come back next year?
I think I'm just gonna stay loyal to the social inequality topic, because I think we're just starting to look into that issue, and it's gonna take us years before solving it. And I think we can have a broad understanding of social inequalities or social equality issues. You know, it's about decent work, but also about diversity and inclusions, and we have a lot to do.
We do.
I would stay with that topic.
As a whole panel for itself, I think, for next year's conference. Take note, Jeffy, and then Andrew. Finally, how about for your company? What are you guys looking at as emerging issues?
Well, listen, we've covered such a spectrum of issues at this panel. It's been fascinating, and you know, this shows why S is ever dynamic and ever changing. I'll add a few more to the mix of things that we're looking at in some of our own internal research groups. So, ethical AI is a big theme. So you're starting to get many more companies using AI for, you know, products like risk-based pricing for sort of loans, consumer finance loans, and insurance premiums. And ethical AI could either lead to much better sort of pricing of those products and, you know, more equitable outcomes, or it could lead to the industrialization of bias against a whole number of socioeconomic groups. So we need to kind of really understand that and understand how it's been applied and the governance of you know, ethical AI. So that's one. A second area that we're really fascinated by, I think is really important, is the social impact of gaming. Gaming has become the world's biggest leisure activity, and not just gaming, but watching people playing gaming. It's one of the most watched channels on YouTube, as anyone who's got sort of 12 to 15-year-old will know.
You're making me feel very old, Andrew.
Well, so, you know, gaming has just the most enormous potential as a sector, but also potentially enormous social impacts. We just don't know yet what the impact is of some of the contemporary generation of games. They're so much more engaging and dynamic and sort of mesmerizing to young brains than anything from our generation. You know, it was very hard to get addicted to Pac-Man, frankly. At some point you gave up chasing sort of dots around the screen, but, you know, Call of Duty, games like this, Fortnite, entirely different. So the social impact of gaming, we think, is a really big issue. And then the final one I'll mention, and it's been sort of alluded to by Leslie Ann, around, you know, the infrastructure around digital payments. I think the social impact of virtual currencies and, you know, Bitcoin is an enormous theme. So that could be incredibly supportive of, you know, wider SDG goals in terms of reducing the fees for remittance payments, for example, for migrant workers, as Bitcoin becomes legal tender, you know, in countries other than El Salvador, which has been first out of the blocks. Or it could be one of the catastrophes of the future, you know, if not handled the right way. So I think that's an enormous area for further research, and so lots to keep us busy on S.
Absolutely, and lots for, I think we just wrote next year's agenda for the social day of the summit, and I think you guys will all want to come back and participate. Leslie Ann's just messaging Andrew in the background to challenge him on one of his points, but we have run out of time, unfortunately, so I will have to just wrap up. It would be remiss of me, given that Andrew's mentioned gaming, for me not to suggest to all delegates with children that if you are interested in gaming for good, you should download a game called Island Saber, which is entirely free, available on your console, or if you're in the UK on a mobile device, but it's on consoles globally, which my team produced last year. And it's all about recycling and saving the planet, and also teaches kids how to use money effectively. So download Island Saber, give it a go. But that wasn't why I'm here. I'm just taking advantage. ESG, thank you very much. It all started with S, we learned in this last hour. but actually all the issues are completely interconnected, and it's a bit of a fake distinction to suggest that we can deal with E, S, and G separately. There's a big difference between data and insight, so there's lots more that we can do on the qualitative and the quantitative, but ultimately when it comes to social, we are all Jon Snow. We know nothing. And with that, I will hand back to the conference.